All right, stop scrolling for a second because something just broke in the silver market and it's still unfolding as we speak. In less than a week, silver went from $121.64 to an intraday low near $71. That's almost $50 vaporized, fast. As markets opened Monday, spot silver tried to catch its breath around $81 to $82, still down more than 30% from the peak. And here's the part most people are missing. The real trigger wasn't panic or headlines. It was mechanical. The CME just raised margin requirements by roughly 36%. And when Asia and Europe reopened, forced selling kicked in. Stay with me, because I'm going to show you why this matters right now and how to spot it next time before the crowd does. If you're holding silver, if you're watching this unfold, if you're trying to figure out whether to buy this dip or run for the exits, your job right now is to understand the mechanics, not the narratives, the mechanics. Before I explain what actually caused this collapse, let me teach you something most people never really internalize about leveraged markets. Price doesn't always move because fundamentals changed. Sometimes price moves because the plumbing breaks. And I mean that literally. Think of leverage like driving with cruise control on an icy road. Everything feels smooth. You're making progress. You feel in control, and then conditions change. The road gets slick, and suddenly the system forces you to slow down whether you want to or not. Margin is that system. It's the governor on your speed. When exchanges raise margin requirements, they're effectively saying, you need more cash to keep this position open. And if you don't have it, you don't get a vote. You sell. Not because you want to. Not because your thesis changed. Not because you stopped believing in silver. Because you have to. It's forced. It's mechanical. It's binary. Now here's why this matters so much in a market like silver. Silver attracts leverage. It's volatile. It moves fast. It gets retail traders excited. And when you've got a massive run from, say, the 70s into triple digits in a matter of weeks, you're pulling in momentum traders and leveraged retail along the way. These aren't long-term holders with deep pockets. These are traders using 2 times, 5 times, 10 times leverage trying to ride the wave. And that's fine when the wave keeps building. But the second the exchange says, hey, you need 36% more capital to hold that position, the game changes instantly. You either wire cash today or you liquidate. There's no middle ground. And most people don't have extra capital sitting around waiting for a margin call. So what happens? They sell. And when enough people sell at once, price drops. And when price drops, it triggers more margin calls. And those margin calls force more selling. You see where this goes. It's a cascade, a feedback loop. And none of it requires anyone to change their long-term view on silver. It's purely mechanical. Let me walk you through the actual sequence here because this is where understanding turns into an edge. Silver runs hard, up to 121.64. Euphoria's building, momentum's strong, everyone's talking about it. And then the CME steps in. They hike margins by about 36%. Now that's not a suggestion. That's not a warning. That's an immediate capital call. It hits the system overnight. So when global markets reopen, when Asia comes online, when Europe comes online, traders who are already stretched suddenly need cash. They start liquidating, not because they think silver's going to zero, not because they read some bearish report, because they literally have to post more collateral or get closed out. That selling pushes price lower. Let's say it drops from 120 to 110. Well, guess what? That triggers more margin calls, because now people who were fine at 120 are underwater at 110. So they sell. Price drops to 100. More margin calls, more forced selling. By the time you hit the 80s, then the 70s, you've got a full-blown cascade. This is what forced deleveraging looks like in real time. But here's the part that should make you nervous if you're thinking about chasing this bounce right now. We're not done yet. Because forced selling creates secondary effects. As price collapses into the low 70s, volatility explodes, liquidity thins. What does that mean? It means bid-ask spreads widen. It means if you want to sell, you might have to take a price $5 below where the quote was 2 seconds ago. It means the market's not functioning smoothly anymore. It's lurching. And that validates the pressure. It tells you the stress is real. Now add the convergence layer. You start hearing reports about positioning by big banks. You hear about temporary disruptions at the London Metal Exchange. HSBC issues notices around clearing and collateral requirements. Whether or not you believe the crash was engineered, and we'll talk about that in a minute, the effect is the same. Leveraged players get flushed. Weak hands exit. Stronger hands wait. They're not buying the first dip. They're waiting for confirmation that the forced selling is actually done. And this is critical. Early rebounds in this kind of environment are notorious for failing. I want you to hear that again. Early rebounds after forced deleveraging events are notorious for failing. Why? Because the system hasn't found equilibrium yet. There's still margin calls working through, there's still volatility, there's still fear, and what looks like a bounce at $81 could easily turn into another leg down if the forced selling wasn't fully flushed. So when you see silver recover $10 or $15 off the lows, don't assume that's the bottom. Don't assume the coast is clear. Assume you're in the middle of a deleveraging cycle that's still working itself out. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know if you're seeing this in real time or catching up after the fact, because timing matters here. Now let me show you why this pattern should look familiar. Because this is the exact same playbook we've seen before. Go back to 2011. Silver had an epic run. It hit nearly $50 an ounce. And then what happened? The CME raised margins. Not once, multiple times. And silver collapsed. It bounced hard after the initial drop. People thought it was over. And then it rolled over again. It retested lower. It kept grinding down for weeks before finding a real bottom. Same mechanics, same cascade, same false rallies along the way. If you bought that first bounce in 2011, thinking you were getting a gift, you got crushed on the second leg down. Let's go to March of 2020. Totally different market, totally different catalyst, but same mechanics. The COVID panic hit. Liquidity dried up across everything. Stocks, bonds, commodities, everything sold off hard. You saw massive liquidation events, and then you got sharp relief rallies. People thought, okay, we bottomed? Nope. Markets retested. They searched for equilibrium. They needed time to digest the forced deleveraging, the forced margin calls, the forced exit of weak hands. Volatility didn't just disappear overnight. It compressed, it expanded, it retested, over and over until the system stabilized. Here's what I want you to see. When you zoom out and look at those Mondays after big crashes, whether it's 2011, 2020, or right now in 2026, you see the same rhythm. You see forced selling, you see a bounce, you see retest, you see compression. The larger story, the thing that doesn't change, is that markets need time to digest forced deleveraging. Time, not hours, not a single session, days, sometimes weeks. Price alone doesn't confirm anything. Price just tells you where the last trade happened. Behavior confirms. Are people still selling into strength? Is volatility still spiking on down moves? Are bid-ask spreads still wide? Those are the signals. Those are what tell you whether the pressure's easing or whether you're just in the eye of the storm. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this stabilize here and rip higher? Of course it could. Markets don't owe anyone symmetry. Just because I'm showing you historical patterns doesn't mean this has to play out the same way. Maybe the forced selling's done. Maybe Monday's low at $71 was the flush. Maybe we rally from here and don't look back. It's possible. And claims of manipulation, let's talk about that. Big players always benefit from volatility. They do. Whether it's banks, whether it's hedge funds, whether it's market makers, they make money when markets move. But that doesn't mean every crash is a conspiracy. The thing about margin hikes is they're public. They're rule-based. They're blunt instruments. The CME doesn't hide when they raise margins. It's announced. It's transparent. You don't need a villain for this to happen. You don't need some shadowy group pulling strings. All you need is leverage, volatility, and a margin call. That's it. So instead of obsessing over motives, instead of trying to figure out who's manipulating what, focus on what you can actually observe. Is selling pressure easing? Are we seeing lower volume on down moves? Is volatility compressing instead of expanding? Are closes improving into the US session? These are observable. These are measurable. These answers matter more than narratives, more than theories, more than what some anonymous account on Twitter is telling you. Watch the behavior. Watch the mechanics. That's where the truth is. There are probably 3 types of people watching this right now. Let me talk to each of you directly. The first is the long-term believer. You love silver. You've been stacking for years. You believe in the fundamentals. You believe in sound money. You believe in the inflation hedge thesis. And this move, this collapse, it feels like an attack. I get it. I understand that feeling. For you, the question isn't price. It's survival. It's making sure you don't get shaken out at the worst possible moment. So here's my advice. Don't overextend. If you're holding physical, you're fine. Physical doesn't have margin calls. Physical doesn't expire. Physical sits in your safe and waits. But if you're holding futures, if you're holding leveraged ETFs, if you're using margin, you need to be honest with yourself about your exposure. Can you survive another $20 drop? Can you survive a retest of the lows? If the answer is no, if you're at risk of forced liquidation, you need to reduce. Not because the thesis is wrong, because position sizing matters more than being right. The second type is the trader eyeing the bounce. You see $71 to $81 and you think opportunity. You think, man, if I can catch this at 75 and it runs back to 100, That's a massive win. Maybe. But ask yourself, are you trading confirmation or hope? Are you waiting for actual signs that the forced selling is done? Or are you just hoping you're picking the bottom? Because hope is not a strategy. If you're going to trade this, wait for pressure to ease. Wait for volatility to compress. Wait for a close above a key level with declining volume on pullbacks. Trade the confirmation, not the anticipation. The people who get destroyed in these environments are the ones who try to catch the falling knife. They buy too early. They average down. They run out of capital before the actual bottom forms. Don't be that person. The third type is frozen. You're watching from the sidelines. Maybe you don't own silver. Maybe you sold before the crash. Maybe you're just trying to learn. That's okay too. Sometimes the best trade is information. Sometimes the smart move is to watch, to learn, to understand the mechanics, so that next time you see this pattern forming, you're ahead of it instead of caught in it. For you, the lesson here is simple. Leverage amplifies everything. It amplifies gains on the way up. It amplifies losses on the way down. And when forced deleveraging happens, it doesn't matter how right you were about the long-term thesis. If you can't meet the margin call, you're out. So here's what I want you to answer in the comments. Which type are you? Are you the believer holding through this? Are you the trader looking for entries? Or are you the observer learning the patterns? Let me know, because I'm curious where this audience is positioned right now. The universal principle for all of you, no matter which category you're in, is this. Control your exposure before you try to control your outcome. You can't control what the market does tomorrow. You can't control whether silver goes to 60 or 120. But you can control your position size. You can control your leverage. You can control your risk. And in volatile environments like this, that control is everything. So here's where I stand personally. I'm not panicking and I'm not chasing. I'm watching. Let me tell you what I'm watching. First, I'm watching that $80 to $82 zone. Does it hold? And more importantly, does it hold with declining volume? Because if we're sitting at $81 and volume is dropping off, that tells me the forced selling might be exhausting. If we're sitting at $81 and volume's still spiking on every dip, that tells me there's more pressure underneath. Second, I'm watching the $70 to $75 area as a potential deeper washout zone. If the forced selling wasn't fully flushed, if there's another round of margin calls, that's where I'd expect price to retest. And if it does, I want to see how it behaves down there. Does it bounce quickly? Does it find buyers? Or does it just sit there bleeding? Third, I'm watching volatility into the US close, because confirmation matters more than price right now. I don't care if we close at $83 or $78. I care about how we get there. Are we grinding higher on stable volume? Are we whipsawing around on low liquidity? That behavior tells the story. Based on everything I'm seeing, this event was mechanical, not emotional. It was structural, not sentiment-driven. The fundamentals didn't vanish in a week. The reasons people were buying silver at $120, whether that's inflation concerns, currency debasement, geopolitical uncertainty, those reasons are still there. But if history rhymes, and it usually does, stabilization takes time. The deleveraging process doesn't resolve in a day. Early bounces lie. They look like bottoms. They feel like gifts. And then they fail. So I'm patient. I'm watching for confirmation. I'm waiting for the system to find equilibrium before I make any aggressive moves. Now, I'm not a financial advisor. This is not financial advice. I'm not telling you what to do with your money. I'm showing you how I'm thinking about this. I'm showing you the patterns I'm watching. I'm showing you the mechanics that matter. You need to do your own research. You need to make your own decisions. You need to understand your own risk tolerance and your own financial situation. But if you want to understand how these markets actually work, if you want to see behind the headlines and the panic, this is it. This is the lesson. If you made it this far, you're the kind of person who wants to understand, not just react. That mentality will serve you well, not just in this silver situation, but in every market you ever trade, because the mechanics don't change. Leverage, margin calls, forced selling, cascades, deleveraging. These patterns repeat over and over across different assets, different time periods, different circumstances. Once you learn to recognize them, you stop being surprised. You stop being caught off guard. You start seeing them coming. So do me a favor. If this breakdown helped you understand what's actually happening in silver right now, share this video. Send it to someone who's confused. Send it to someone who's panicking. Send it to someone who wants to learn. And if you're not subscribed, hit that button. Because I'm going to keep breaking down these patterns as they develop. I'm going to keep showing you what very few people are talking about. Not hype, not predictions, just analysis, just mechanics, just the truth about how these markets actually work. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.